Hello, my friends. Today is January 13th, and this is Markets Weekly. So, this week, we're going to talk about three things. First, we got some really important inflation data the past week, and it moved markets. Let's talk about what the data is saying and what it might mean for markets going forward. Secondly, I've had a long-standing question on consumer credit. The overall state of the consumer seems quite strong. After all, unemployment is low, wage gain is high, net worth is high, and consumer spending continues to chug along. But at the same time, there's some data that suggests there is serious weakness in pockets of consumer credit. Now, there's a Fed study that just came out the past week that reconciles these two facts. Let's listen to what the study is saying. And lastly, this past week, we also got the preliminary annual financial statements of the Fed, and it's showing a whopping 100 billion plus operating loss. Let's talk about the mechanics behind this and why it's really not that important. Okay, starting with inflation. So at a high level, inflation is basically the change in the overall level of prices. It's a very difficult thing to measure since we have hundreds of thousands of different prices and they all move in different directions. And so in order to get a sense of the general tendencies, people construct indexes of prices, and there are a few. Now this past week, we got CPI and PPI. CPI is the Consumer Price Index, which measures prices paid by consumers, and PPI is the Producer Price Index, which measures prices paid by businesses. Now CPI came in a little bit hotter than expected. It wasn't hot, but it was warm. If you look at CPI on a month-over-month basis, you notice that, well, we got kind of a jump the past month, but it is a noisy series. The higher than expected CPI seems to be driven by higher than expected shelter prints. So shelter, the way that the CPI measures shelter, it measures average rents rather than newly signed leases. So because that's the case, newly signed leases is a leading indicator of CPI shelter inflation. Now, when you look at the Zillow rent index, you'll notice that rents increased significantly during the pandemic, but the pace of increases has moderated significantly. And so CPI shelter has basically been following that path. The expectation then is CPI shelter, while pretty lumpy, will continue to moderate going forward. And so this increase in shelter could be a one-off thing, but it's hard to say. One thing to note is that, and I get this from Michael Ashton, the inflation guy who studies this, is that if you look at rents from a cost perspective, so from the landlord's perspective, you notice that landlord expenses are rising. So property taxes are rising, as is home insurance. So if you have your costs rising, then that kind of puts a floor as to how low shelter inflation can go, and that's something to think about going forward. Now, the second inflation index data that we got past week was Producer Price Index. Now, PPI data, if you look at a time series, has been pretty disinflationary for the past few months. You have outright deflation in goods, and you also have PPI services that is basically flat. So PPI overall is not really showing any sign of inflationary pressures. Now, even though we got PPI and CPI data, these two price indexes are not the most important one. The most important one, which is the one that the Fed looks at, is PCE, which is personal consumption expenditures. We did not get that the past week, but with the data that we had, we can make a pretty good forecast as to what PCE will show when it's published. Now, the Cleveland Fed Inflation Nowcast PCI forecast is showing that PCI is going to come in at a pretty benign number. So you'll notice that it has a 2 handle. So, that's pretty close to the Fed's 2% inflation. So looking at all this inflation data, what is our takeaway? Remember, we're looking at this because the Fed is focused on inflation and the Fed's actions are what move markets. Well, the market has kind of already spoken. The market's verdict on all this inflation data is a very dovish Fed. We can see that over the past week, interest rates declined significantly from the front end to the belly. The market is pricing in around 7 rate cuts this year. So the market is very, very dovish right now. I think something interesting to note is that longer dated yields, the 10-year and the 30-year, actually didn't seem to be all that impacted by this. So it seems like the market's expectation is that the Fed is going to look at this data and think that, my fight against inflation is lower, so I should start cutting rates maybe rapidly. Now, we'll look for additional confirmation of this perspective on Tuesday when Governor Waller speaks. Now, recall, Governor Waller was one of the more hawkish members on the Fed, but he took a more dovish turn and was expressed openness to rate cuts given low inflation data a couple months ago. And so that kind of unleashed a big rally in basically everything. And we covered Governor uh, Waller's pivot in our video a couple months ago. So I think the market is going to be hyper focused on whether or not Governor Waller what the Governor Waller thinks about this latest inflation data and whether or not he will push back against the 7 rate cuts priced in the market. My best guess is Governor Waller will continue to be open to rate cuts in March, assuming that inflation data continues to be benign. I don't think you're going to get that much pushback from him. So that could be a point for potential furtherance in the risk on episode that we're seeing in markets. But we'll find out on Tuesday. Remember, Monday is a market holiday in the US. All right. So the next thing that I want to talk about is the really interesting study that we got from the Fed on consumer credit. So if you look at consumer credit, you're getting a kind of an interesting picture. Now, in the US, everyone has a credit score. The credit score is basically a measure of how creditworthy you are. If you pay your bills on time, if you don't have too big of a balance, your credit score will improve. Now, credit scores can largely be broken down into 2 segments. Prime, which are people with very good credit scores. Subprime, which are people with very bad credit scores. And in between, you can say someone has a near prime credit. Now, when you break down consumer credit delinquencies, say in auto loans and in credit card loans, by credit rating strata, you come away with a very stark picture. Now, subprime borrowers have been increasingly delinquent in their loans. And that's kind of into a shocking extent. And that kind of doesn't make sense because when you look at the overall economy, how can there be such high delinquencies when job growth is fine and overall the economy continues to grow? And many people have been looking at this rise in subprime delinquencies and painting it as a picture of the consumer struggling. But then again, that's kind of difficult to see when you look at the big picture. Now, when you zoom out a bit and look at overall consumer delinquencies, they're really not that concerning. They've risen from very low levels in 2021, but they're basically around where they've been the past 10 years. So it really just seems to be this particular subprime pocket of consumer credit that seems to be struggling. How do we reconcile this? Well, this interesting Fed study seems to say that this thing that you're seeing in in subprime delinquencies, well, it's just because credit scores are inflated. And so what was subprime today is basically people that would have never gone a loan in the past. Let me put this in grade inflation terms. So in the US, let's say 2 decades ago, most people got B's or C's and very few people got A's. So when you got an A, you were doing a really good job. Now, fast forward to today, when you go to university, basically everyone gets an A. Some people get B's and almost no one gets a C. If you get a C today, you are really, 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 really in trouble and you did really poorly. Now, it seems, according to this research, that the same thing is happening in credit scores. Now, since we've been in benign economic times, everyone has a job, everyone is, paying their bills, credit scores have risen for a lot of people. And basically, they're inflating upwards, such that the people who are rated subprime today are actually, historically speaking, really, really bad credits. So what the researchers did to correct this is that they recast the data by keeping everyone's credit score today back to where it was in 2019. So basically taking away some of that credit score inflation. Now, when you take away the credit score inflation, you walk away with a picture of delinquencies that's much, much more benign than before. You'll notice that subprime delinquencies risen a bit, but still very much within historical ranges, kind of what you'd expect in an economy that's growing but at a slower rate. And of course, prime and near prime delinquencies tick up a little bit as well, but just a little bit, and solidly among historical ranges. So the takeaway I get from this is that this concern about subprime delinquencies is completely unfounded, and it's merely due to a change in measurement or credit score inflation, where people who are really, really, really bad credit somehow became subprime and never should have got loans, but did get loans. So now that actually makes a lot of sense to me. So I don't think there's any concern in consumer credit at the moment. Again, this is more consistent with the totality of the data. Okay. Now, the last thing I want to talk about is this super interesting preliminary annual financial report we got from the Fed this past week, which shows that the Fed made an operating loss of over $100 billion. And that's a lot of money. Now, how does this actually work? How is it possible for a central bank to have such a large operating loss? Well, at a high level, the Fed is like any other bank. It has interest income from the assets that it owns, and it has interest expense by paying interest on its deposits. Now, for the Fed's case, its assets are all the treasuries and agency MBS it bought during its QE operations, and its interest expense are the interest it pays on reserves, which are basically deposits that commercial banks hold at the Fed. So the Fed bought tremendous amounts of securities when interest rates were low in 2020, 2021, and also aggressively hiked interest rates, thus hiking its interest rate expense. This has placed the Fed in a large negative carry position where it basically keeps losing money. And you know what? The Fed is not like you and I. It can print money. So even though it's losing money, it doesn't really matter. It just prints money and it makes up the difference. It's not a problem at all. Now, one other thing to keep in mind is what the Fed does with its income and its losses. So when the Fed has an operating profit, what it does is that it kicks that profit back to the US Treasury. And for the 10 years after the great financial crisis, the Fed was a tremendous profit center. After all, interest rates were zero, so the Fed basically owned a whole bunch of treasuries and agency-backed mortgages and was funding them by paying 0% interest. So for the 10 years after the great financial crisis, the Fed made the Treasury over $1 trillion. Huge profits. And so that was all good. Now that the Fed is making a loss, it's not going to ask the Treasury for money to make up that loss. What happens is that the Fed simply stops remitting profits to the Treasury. After all, the Fed has no profits. And eventually, in the future, when the Fed gets back to making an operating profit, what it will do is that it will use that money to repay its losses. And then when its losses are finally fully repaid, it will begin to resume remitting profits to the Treasury. Now, it's hard to know exactly when that will be. It will depend on the size of the Fed's balance sheet. So that is to say the pace of quantitative tightening and also the path of interest rates. Now, my best guess is the Fed will probably be earning a profit in probably 2 years. But again, really hard to say. Now, the path of QT is also unknown at the moment. Right now, we have a public debate among Fed officials as to how to think about the tapering of QT, which of course will help decide when QT stops. Now, I will write about this in my blog where I lay out the different arguments made by Fed officials and my best judgment as to how QE will be ended going forward. But in any case, so basically the Fed printed $100 billion because it had an operating loss. $100 billion in the grand scheme of things sounds like a big number, but I think for an economy the size of the U.S. government, not that big a deal. It's going to make some people in Congress mad, and it's going to make Jay Powell have I guess, an uneasy congressional hearing in the future, but ultimately, it's really just not that important. My expectation is this operating loss shrinks this year as rates get cut. Okay, so that's all I prepared for today. Thanks so much for tuning in. If you're interested in my thoughts, check out my blog, fedguide.com, where I try to keep you abreast on the latest developments in markets and my views on it. And if you're interested in learning more about how markets work, check out my classes at centralbanking101.com. All right, guys, talk to you all next week.